Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Fuquan Bilal. He is the host of a Passion for Real Estate podcast, and he also has a fund with the National Note Group. Anthony, what were a takeaway or two that you had from this interview?
I really enjoyed his story of kind of how he came, how he worked his way up, which I thought was really cool. But I tell you, my biggest takeaway is he shared how he ran into kind of like a fork in the road or to an obstacle. And what he really did, his son gave the father the same advice he's been giving the son. And it just kind of, he's like, oh, I mean, well, the story is like he wasn't sure what to do. And then the kid's like, well, why don't you own a bank or become the bank? He's like, well, that's not possible. But then the son's like, well, you told me anything's possible. And what that did is that forced him to kind of shift his mindset. And you know what? It made me think, how many times do we know the answer to the problem? But part of it out of fear or a scarcity mindset, we don't, right?
Yeah.
And so I thought that was really cool. What was your takeaway, Cam?
One of the things that Fuquan had said, and I don't know if this is going to make the recording or not, but it was right when we jumped on the call. He said that he is trying to scale to be better, not bigger. And I really like that quote because most of the time people are trying to get to be the biggest, baddest, whatever, version of themselves it is. And I really appreciated that sentence to begin with. And then later on, it really connected with me with his hybrid model of kind of what he does on the investment side. He's got a little bit of single-family residence, some fix and flip, and then he's also got some note investing. So he's staying very versatile, just to better serve his client. So I saw that correlation in there, and I just really enjoyed that sentence.
Well, great. Enjoy the episode.
Take care. Fuquan, hey, man, we are very excited to have you here with us today, and we're just going to dive right into it. I know that you've got a lot of experience in fix and flips, some wholesaling, and some notes. If you could you tell us how you got started in real estate?
Oh, yeah. It was back in 1999. I was working a corporate job, and I was actually shadowing my cousin, who we've been like competitors since, 12 years old, right? Who had the best sneakers, who had the most money. This all competitive. And I was working for corporate, and he started to flip houses. And I remember he did a deal and he made half my paycheck, and he said, you're working for the man. I made half your paycheck in 60 days.
Just rubbing it in.
Yeah, just rubbing it in. So I started to shadow him around, and I was curious about it. My older brother, he was a mortgage broker. Actually, he was a loan officer. Let me correct that. He worked for a mortgage broker. And he was trying to get me to get into that part of the business. And I was like, dude, I don't want to wait 30 days to get a check. Because he's like, hey, you built this pipeline and everything just fall like dominoes and you just send the money. And I was like, I want my every 2-week paycheck. I'm comfortable. At the time I was like 24 years old. I was making $85,000 a year base plus commission. I was the happiest kid in the world, coming from where I came from to end up in a job like that with corporate in sales. And I was like, this is it. Get my gold watch, retire, and that's it. Get my pension, and that's it. So I shadowed him around, and really in about less than a month, I had found a deal, and it took me some time to put everything together and found a buyer and sold it. And I too made close to half, 30-something thousand, if I can remember, maybe 38,000, whatever it was. Almost half my salary. And I was like, wow, I did this in less than, 2 months, 2 or 3 months. This is crazy. Imagine if I did this full time, what I can do. And immediately I remember the owners had went to Europe to like a trade show or something. And, I put my 2-week notice in while they wasn't there. It was easy for me to do it while they wasn't there. I just sent them an email and boom, that was it. I left the company and I started to do real estate full time. And the first 6 months was.
Do you mind if we interrupt? I
Sure.
don't mean to interrupt, but I want to dive a little deeper here.
Sure.
You're just kind of glancing over. Hey, I made half my paycheck, so see you later, corporate America. Like
That's
you're
it.
jumping in. Like
That's
tell
it.
us about that mindset. I mean, because I think a lot of people here, maybe they've done some deals or they've done a couple, but making that jump to put in your 2-week notice is a big deal. You mind explain maybe some of your mindset when you were contemplating that decision?
Yeah, for sure. I mean, it started, I believe, maybe from when I was 9 years old, if I can remember. My mom used to take us out to these bazaars, these flea markets, where she would buy stuff from Chinatown wholesale, and then she would rent a booth for I think it was like 25 bucks or 50 bucks for the day. And this empty parking lot this guy had, and he would rent spaces out, and she would vendor, and she would give us stuff and say, hey, whatever you sell, you'll get X amount. And me and my younger brother would go out, we would hustle, we would make money. So she kind of instilled the entrepreneur spirit in us at a younger age. So I always was into sales from early, and we always done things in the community. I grew up in the Islamic community, whether we sold newspapers or we sold the Muslim oils or whatever it was. We were always had a something we were doing to generate income. And just from me doing that, I like being my own boss, so to speak. And when I went to work for corporate, I came in and I made it. I was a person who made a difference in the company. I came in, I increased sales, I increased numbers. I went from different departments, increasing numbers, getting promoted in a short period of time, and I was adding a lot of value to the companies I was working for. And I started off in telemarketing all the way to computer sales. And I landed a big Sony Lowe's account. And at the time, the owners, again, they had me at a base of 85,000 plus commission. And when I landed this Sony Lowe's account, it kind of doubled what I was making, right? I was making close to like 180,000 with this commission that came in. And the two owners took me out to lunch and they said, hey, listen, we didn't know that you was going to land this big account. Great, everything is good. But what we want to do is we want to lower your base to $50,000. But if you have the potential to get another account, you can make over $200,000. And I was like, well, that was what we didn't agree on.
Wait, kind of what I'm hearing, you've done so well that we're going to lower your salary.
Exactly. And then I try to negotiate, well, if you're going to do that, then pay me a higher commission. Pay me a higher commission. And if it's based off of you saying, hey, you're such a great sales guy, the sky's the limit, then increase my commission. If you're going to lower my base, don't keep my base, lower my base and keep my commission the same. And it was this bad taste in my mouth after the lunch, and they wound up going to Europe for a couple of weeks for a trade show. And I wound up closing that deal at the same time. And it was like some bad feeling. I was like, you know what? I don't need this. I'm out of here. I'm a difference maker. I brought the largest account to this company. This company's been in business for 20 years, and I brought the largest account it's ever seen in 20 years. I got it from another. Short story is I worked for another company that wasn't too far away, and they kind of downsized. And I knew somebody who had the account. They wasn't servicing it properly. The person left and went and did business anywhere else. I kind of reached out to them, brought them in for a tour, and made it happen. It took me like about 6 months to get the account, but I got the account, and boom, that was it. The largest account the company ever landed. And it was celebration time until they took me out and was like, hey, well,
man,
didn't know you was going to do this.
Yeah.
You're probably thinking, hey, we're going to give you a raise. You've done so good.
Yeah. I'm like, oh, the commissions was good. I'm going to be over it. I get to show my cousin his check now.
Yeah.
And they kind of gave me a gut punch, and he came in teasing me, and I was like, you know what? I think I'm going to go to this side. And then it was a lot of work, I tell you, man. I made the money, and because I was taught financial literacy. I went out, I bought a BMW 7 Series, young 24-year-old kid, BMW 7 Series. I think it was like a 96 model. And this was like in 90, somewhere around early 99. And, I was balling, riding around, spending money. And, that was it. I blew through the money so fast. I remember, I believe 8 months later, going through a toll booth. Like here in New Jersey, we have Garden State Parkway. And dude, I didn't have 35 cents to pay the toll. I was digging in my ashtray for pennies to try to pay the toll. I was like, what happened? I was waiting for the next deal, right? So then my brother said, hey, what happened to the comfort job? My brother, that's the loan officer now, because we had made some connections, through the real estate business also. And he was like, you're not supposed. Nobody ever taught me this stuff. I never had financial literacy. So for me, it became when you flip houses, you kind of live from deal to deal, right? I never learned the cash flow part. I didn't learn that until the market crashed.
Mm.
But I was just flipping properties, 30,000, 60,000, 50,000. The chunks of cash was sexy. And I lived off of that rush. If I could 10 closings in 2 months, I'll make X amount. So that was my main focus, not really understanding cash flow. I was young and immature. So, I made it, I did a lot of transactions before the market ultimately wound up crashing, but I didn't have I didn't want to do no tenants. I didn't want to do any. I sold the idea that, hey, you can buy a 3-family house, you can rent it, put tenants in, get that cash flow. I'm your guy, but I was never the guy on the other side that actually played the landlord business. I think I tried it out, maybe 1 or 2 properties, and I was just disgusted in the areas where I was invested in the hood. So back then it was, you had to go knock on the door, collect the rent. There was no Appfolio or online payment. You had to go in person and collect your rent because nobody would mail you a check, right?
Yeah.
It's very seldom people in those areas will mail you a check. And good luck after you collect all the rent coming out of the property and not getting robbed, right? So I never wanted to deal with that. So I just sold properties and was very good at it.
So you did that. So I'm trying to put the piece together, the timeline. 99 to, you said the crash, 2008-ish?
Yep. 2008 had a nice long run. Had all of the latest cars, all of the Louis Vuitton, Gucci, traveled to Europe, did all the other stuff. I didn't have any gold chains or any Rolex watch. Well, I had one Rolex watch. I had a Yachtmaster for a wedding gift, but that was it. I went through that whole thing, and then I got my ass handed to me and punched in the face at the same time when the market crashed because I thought I was God. I knew everything. I wasn't tapped into masterminds. I wasn't going to real estate meetups. I knew it all. I mean, I was a young kid. I was a millionaire when I was 28, and you couldn't tell me anything. And I couldn't see the writing on the wall when the market crashed. It just overnight turned upside down. Banks pulled a lot of loans. I had the closing table. But I made it out alive. I lost $2 million of my money because I would put up the construction money and then pay all of the interest to the investors as I was flipping the properties, and they would just put up a percentage of the purchase money. So I had skin in the game, and I wound up doing fire sales, paying everybody back, didn't file bankruptcy, and had to start all over again. So, and then after that, I got divorced. So yeah, that was the icing on the cake.
Rough little run there, huh?
Yeah. Okay, now I'm curious, what would you say to somebody, because there are a lot of flippers that do listen to this. What would you say to that young flipper who's living off of those deals, right? And things are good. Like, or kind of like, what would you tell yourself? Would you tell your 26, 27-year-old self as far as managing their personal finances?
Oh, cash flow is king. To me, back then when I looked at it and I said, what would you rather have, a closing and make a $40,000 hit or keep the property? I didn't know about collateralizing the properties to buy more properties. It was either making $40,000 or $400 a month cash flow with the equity. And I was like, I'll take the 40,000.
Yeah.
All day long. Like any young kid would say that. So it wasn't like, okay, I need 20 of these properties. They're going to appreciate. I get the chance. If I sell one and have them all in the same LLC, I can take the depreciation from the other rentals and put it with that. I wasn't educated in that way. So to me, it was just like, get the bag now and keep it going because you never know. So the little $400 a month wasn't appealing at all. I wasn't saying I'm going to get 10 properties and I got 4,000 a month, and I wasn't thinking that way. And I didn't understand. So I would tell myself cash flow is king. You can do both. You can have rentals and you can do some flips, right? So you can pay down the loan on the rentals to increase your monthly cash flow, right? That's the route I wish I would have taken. I'm way further than I was back then. And that was, to me, was like kindergarten. I went through there, I got my bumps and bruises. I learned the basics. Yeah, I got punched in the mouth. I fight better with blood in my mouth anyway, right? So
I like that.
And that was a learning. That was hard knock school for me. And when I got divorced, it kind of made me it kept me grounded. Um, that's when I became a real father to my kids because there was no deals to chase. I wasn't a slave to money anymore. I became a master of it and started to really work on myself. Like your business only grows to the extent that you do. I think Jim Rohn said that.
Mm.
So I started really diving deeper into myself and trying to become a warrior. A warrior is one who conquer oneself. That's my definition of a warrior. So when I started to focus more on me and my kids and my foundation, I started to attract things that I wanted. And then I started to attend the real estate meetups and become aware of what was happening in the marketplace, what was going on. And then, that's when I transitioned a little bit into the note business. I discovered that by accident by doing short sales. And I was like, man, this is the best thing. You don't have to deal with contractors. You don't have to, you get to help people stay in their house. At the time, the banks were getting a lot of bad press on foreclosing, putting people out. You're talking like 2000, 2009, 2010. And I really laser focused on the note business and took me a couple of years to understand it. And 2011 came around, 2012, I made my first investment. And basically 2013, I opened up a fund to start raising capital so I can buy these things at a bigger discount. And after that, I just laser focused on notes. I still did some flips here and there because I still had resources to do them, not on the scale I was doing them before, because I was doing more notes than it focused on the note business.
Now, so for some of our listeners who may not be familiar with a note, do you mind just explaining that?
Sure, a note is an IOU, a promise to pay, cash flow. So it's an instrument that you sign when you go to closing, right? So you go to closing, you're going to sign a note and a mortgage. The note is your promise to pay. So I didn't know at the time that you can actually buy these things, right? And they wasn't readily available to people like us because they were like the best kept secret to like the guys on Wall Street and the hedge funds. But because there was an abundance of paper, and all these bonds collapsing, and the banks had bad reputation of foreclosing, they just started selling dumping these things on the market for pennies on a dollar. And you can actually buy, let's say somebody took a HELOC, a second mortgage on their house to do the kitchen, and they went into default, or they had those 80-20-10 loans, whatever they had, the fog and mirror, you get a 200% LTV loan. And basically, whatever the second mortgage was, let's say it was $50,000 face value at the time, and you can get that second mortgage for maybe like $7,000. Now the debtor still owes the $50,000. They don't even know you paid $7,000 for this debt, and then you can kind of work with them and share your discount with them. Hey, Mr. Homeowner, $15,000 right now. The debt is over. We'll eliminate it. We'll release the lien from the property. What homeowner wouldn't want to do that if they had the money to do it? Or you can even structure where they pay you that over a year. You're still doubling your money. Or if they can get back on track, you can, hey, let's work this out. The face value is 50,000. You was paying 600. Pay me 400. And then you can season that asset by collecting payments for a year, and the face value is still 50,000. You can turn around and sell somebody that same note for $35,000 with a $400 a month payment. Like that's a great return. Like if you got $35,000 in the bank right now, you're not making $400 a month for 20 years, right? So I don't know if most listeners catch that, but that's the note business. You can buy it at a discount, season it, what we call building a payment stream where they start paying on time, and then you can sell it for a percentage of the face value. So you can flip a note that way on the back end, or you can keep it for cash flow,
Well, to me, it sounds like it's like you're flipping a note just like you were with the land.
Same
right?
way. You rehab the note, which is called the workout modification.
Yeah.
You collect payments for a year. Now, once the borrower is back in the habit of paying, you can sell it at a discount, the face value, depending on yield. So you buy it off a yield. So whatever their yield threshold is, if they say I want double digit, you would sell it for a lower amount. If they want, if you can sell it for eight yield and 9 yield, you sell it for a higher amount. And that became the game for a while for me. Just laser focus on the notes. I think that's the best investment strategy in the universe, right? It's you get to do this business from a laptop cell phone. You get to give the homeowners a reprieve, help them stay in their house. They are the property manager, and you are the true blue bank. So I stay laser focused on that. And you can do all sorts of things. You can sell partials. You can borrow against them. It's just insane. Like once you get on that side of the fence, you're like, oh, this is what the banks do. Okay. You become the bank. You take the
Yeah.
investor hat off and put the banker hat on. And it's much more sophisticated investment. I love it. And after doing that, I saw pricing started to increase. A lot of people, even myself, guilty of it, started educating others and sharing the knowledge with others. Yeah. And then everybody wanted to come over, and now they're your competition. They're bidding against you. Pricing starting to increase because that business is only a couple of hundred players are in that space. Not too many people, maybe 1,000 or whatever. Not too many people that's in that space. Maybe more than that I know. I don't know. But when I would go to conferences, you would see the same 500, 600, 700 people. And I knew the writing was on the wall. Pricing started to increase. And around about 2015, I started to focus more on real estate because I had these resources, right, with the banks, because I was dealing directly with them to get REOs in my backyard. And I'm like, well, I had people who was not accredited because my fund is actually only for accredited investors, people who, generate $250,000 or more, single, $300,000 or more, or they have $1 million in their asset, not including their primary resident. I had some people who didn't qualify for that and they still had money to invest. So they would become trusted investors on real estate deals. And it was just too complicated for me because, one person would have 50, one person would have 60, one person would have 25. And I'm like, all these small pieces of money, I could put it to work. But if I'm buying a property that's 150,000, I can't put 3 people on a deal, 2 people max. So it was better for me to create a vehicle where I could raise capital to do real estate deals and notes. And today, as I was telling you earlier, we have a hybrid model where we raise capital, and it gives us the flexibility to deploy the capital wherever we see the opportunity, right? Wherever we see the opportunity on the note side or the real estate side. So not just one asset class.
Yeah, because there's a lot of people who maybe they can't be as active as an investor as they would like, or maybe they're interested in notes but don't have the ability or want to learn about them, so they can kind of invest in your fund, and through that fund you guys will invest in what?
Real property, which we buy if we do fix and flips and or rentals, and or we'll buy notes, as I was explaining. We'll buy notes from the bank direct, or any other note seller, loan servicer. We'll buy from those guys. We'll sell it, we'll work it out, we'll get cash flow. So our fund generate cash flow from rental income, generates cash flow from performing notes that are paying, whether we can do a short sale, we can do a discounted payoff. So we derive income from the note side on that. When we fix and flip properties, we generate income from that. So there's a lot of different ways we can trigger income, plus it's diversity, right? Because we are not just in one asset class, right? And shout out to all of the guys who are doing syndications on multifamilies and private lending and the various facets of real estate. Our fund is like a Kiwi almost, because we have multiple assets in one vehicle. So we can execute on different strategies under the same umbrella. So kind of creates a buffer hedge against any market uncertainty. Case in point, the latest fund we launched was in December of 2019, and COVID came in 2020. And you had a lot of people who couldn't pay their mortgage because they got laid off. So that affected a lot of guys who was just in the note business. Our fund, because we are investing in C-class areas, most of our tenants, well, actually 85% of our tenant base is Section 8, battered women and children, those type of programs, where it's government subsidized rent. So we had strong rent collections because the government was taking care of the tenants, the residents, and we were able to collect rents, which carried us through the end of the year. And in 2020, we had just launched a fund, December 2019, really 2020. And we still made a 10% net return after all expenses and everything in the midst of COVID. So we really got a chance to test our hybrid model. And it tested out very well. And now the market is insane. Now the market is crazy where we are. Everywhere the market is crazy.
Now, Fuquan, you're kind of doing 3 different things. We got the notes, we have fix and flips, and then a little bit of buy and hold. Would you mind explaining some of the pros and cons of each?
Yeah. So so with the note business is ordinary income So you don't really get to do any write-offs like the real estate. If for the real estate, you get depreciation. So the notes doesn't have that. So us having it in this hybrid model allows us to do that. So that's one of the pros also. The cons of the note space is that you have to really it's more of a human element involved with it, whereas the real estate is based on you're getting the property at a good discount, you're going to fix it, market appreciation, okay, boom, your numbers are locked in. With the note business, more of a human element. You base it off of someone, if they got divorced, if they got sick, if they got laid off. So that monthly income stream is based off of what's happening in that person's life. What their household looks like. And the credit could be good. You have responsible people who pay their bills on time, like you and I. We make sure we pay our bills, we do the right thing. But God forbid something can happen to us where we, fall on hard times. We might not have the cash flow to take care of certain bills. We might have to renegotiate. That happens to everybody. So, and we've seen a lot of that with COVID, right? A lot of people was calling the collectors and renegotiating. Some people were gaming the system. So, you have a lot of that. What I like about the model that we have set up is that it's not based on one asset class. So even with the rentals, it's all Section 8. It's cash flow, but then you have to think of how you're going to reposition that to sell. If you're going to sell it, if you're going to divest out of those asset classes to go bigger. That's kind of what we're focusing on now, because there's a lot of people who's getting out of the smaller apartment units, 100 units or more, going for bigger deals. And we're looking to grab some of that stuff. So we divest in a lot of the portfolio where we have smaller rentals, 2-3 unit rentals. We get rid of that stuff because, we don't want to get in a position where we have, maybe we have a cash tenant in one and a Section 8 tenant in the other, then a cash tenant lose their job. Now the rent is dependent upon Section 8 tenant, which may not carry the cost. So we said, well, screw that. We got to get into bigger units so it's not contingent upon, rental income from 1 or 2 people. But there's a lot of great pros and cons in there. I would definitely say having a hybrid model gives our investors, like I said, a buffer hedge against any market uncertainty, because they don't have to depend on one asset class. If we underperform in notes, if we have a low collection rate 1 month, it doesn't affect, their return, because we have other income coming in from other streams. I can go out and sell 2-3 flips, right? I have cash flow coming in from rentals and so on and so forth. Or I can sell some notes. I don't have to just depend on income from performing notes. I can go, you know what? Numbers are not looking good this quarter. I need to sell these assets so I can generate some income. Let me put these out for sale. So I can do a lot of different things in the vehicle,
Fuquan, you mentioned that you're mainly dealing with accredited investors, correct?
Oh, correct. Absolutely. My first fund was non-accredited investors. Friends and family was a small fund, $2 million fund. And the people who I borrowed money from before the market collapsed were people who I knew. My landlord in my building that I was renting from, my office building, his friends and associates, a few different real estate investors that I knew would invest with me, Harmony lenders. I leveraged that as well. But when I opened up a fund, it was actually the reason I opened up a fund is one day I was doing a short sale and I was on the phone having some words with the short sale negotiator, and I had just picked my son up from school, and he goes, "Hey, why don't you just open your own bank?" And I'm like, "That's impossible." He's like, "Oh, I thought you said anything is possible." And I wrote about this in one of my books, Turning Distress into Success, my very first book. You can get on Amazon. And that got my mind thinking of, he's right. How can I do this? So I started to reach out to some people who I knew was raising capital, and they was like, "Hey, you just get an SEC attorney or retainer. They'll tell you how to do it." So I got this SEC attorney or retainer, and the first fund cost me about $25,000 to put together. They put everything together, and I was like, "Okay, go raise money." And I'm like, I bet because I got this document, all I got to do is wave this document around and go, "I got a PPM. Give me your money." It doesn't work like that.
And everybody came running, right?
Yeah, that's a whole other business. And my first investment was my cousin, and I think he gave me, like 10,000, whatever it was, and he would call me every 2 weeks. "Hey, what's going on? What do we got? Everything right?" He would see me at the family reunion. "How is everything good? Is everything?" I was so happy to pay him back. Like, calling me every 2 weeks. I was like, here's your money, bro. Leave me alone. But it's when you deal with unaccredited investors, there's nothing wrong with that. It's just that you're limiting yourself to um, investors who may need that money back right away, right? Who may not be as sophisticated as somebody who is investing 100,000, a half a million, and so on and so forth. They've lost money. They understand what an investment deal look like. They understand what the risks look like. A non-accredited investor, they're like, okay, I need you to guarantee me. I'm going to give you this 30,000. I need you to guarantee me I want to get my payments on time and guarantee me I'll get my money back. So, if and I tell this to anybody who's listening, if you're raising capital, you want to let people know, hey, listen, if this deal go wrong and we can't be friends after that, then don't give me your money, right? Because the market is uncertainty in the market. There's high risk.
Mhm.
Even though I have experience, there's still risk. You never know what can happen. So, you have to understand the investment. And I would say for anyone who's raising capital, you definitely want to over educate and continue to educate your investors on what you're doing so they're familiar, they're comfortable with it, they can live, breathe it, and be familiar with it and have more confidence to invest alongside of you. But yeah, we do accredited investors only. These are people who've been around and they understand what an investment looks like. They know how to do due diligence on an investment. Mainly, what I say for people who's looking to raise capital, people are going to invest into your track record. They're going to invest into you with your credibility, um, you know, and that's pretty much it, man. You got to put yourself in the right area where these people are, and you have to do what you say. You know, say what you're going to do.
Now, would you, you mentioned it earlier, but would you just define again what is an accredited investor?
Sure, someone who earns $250,000 a year or more single, if it's you and your wife together, or a significant other, whoever that is, $300,000 a year together jointly. You have to have $1 million in net assets, not including your primary residence. You can have $1 million in the bank, $1 million in your 401k, IRA, and that gets you the qualification for as accreditation. So people who are on that status, they have so much deal flow available to them, right? It's like, why can't this be available for any and everybody, right? Why can't everybody else make 8% of their money or 6% of their money or 10% of their money? Why is it only available to accredited? I don't know why they made this rule. I'm guessing because someone with that much net worth, they deem them to be a little bit more sophisticated, but that's not always the case, right?
No, no.
Somebody can hit the lottery and have $1 million and they're accredited. It doesn't mean that they are sophisticated. So that's why going back to what I was saying before, you always want to over educate people who's looking to invest with you, right? You want to make sure they qualify. Like
Mhm.
just because you're accredited, you might not qualify to my standards. You might qualify to invest in a fund, but you might not qualify to invest with me because your um, core values may not be in alignment with my core values. So it might not be a fit. You might just because you have money don't mean I would take it. You have to be a fit for what we're doing. We have an impact project. We like to go to these communities, make a change, take these dilapidated properties, revitalize them, put them back on a tax roll, get the residents a better place to live. I come from that. So it gives me the feeling of importance to go back to these communities and make a difference. And some people are just all about profit, when I get around the investor and they're talking about profit all day, this and that, they don't have the same core values as me because they're not really trying to create an impact in the community. And that's what our mission is. So, there's still more qualifications than accredited to me.
I like that. And if somebody is looking to see if they are a fit, where can they find you? Where they can get more information?
nngcapitalfund.com. You guys can go there and check it out. Set up a call. We kind of talk more about your investment goals. If you have a financial freedom number you're trying to hit, we'll discuss that as well to kind of see if we have something that fits, what you need to add into your portfolio to get that number.
That's awesome. I want to ask you maybe a couple other questions. One thing you'd mentioned, what had happened, you got success early at a young age, but you didn't have the financial intelligence. So what were some things that you would tell somebody, maybe they're younger, maybe then they're early 20s, early 30s, and they're kind of just, a lot of times we're not taught some of these principles in school, and nor by our parents. So what advice would you give to a young investor for them to learn financial intelligence. And I stop you one thing. You don't need to tell them to listen to the Infinite Wealth podcast, all right? Because they're probably already here. But
shameless.
I was just about to say that.
Yeah, I know you were going to say that, right? And you got a podcast as well, which we haven't even mentioned.
Oh yeah. PFRER, Passion for Real Estate Investments.
Perfect. So in addition to those two great podcasts, what other advice would you give a young investor?
Yeah, sure. Get around people who are actively investing, get to know them, figure out what makes them tick, figure out how you can protect yourself from taxes, learn all about IRAs, about trust. Really, I would say and this is, cliche, your network is your net worth. Um, I would really say, really, what is your purpose? Like, what are you trying to make money for? What is the end game? And whatever that is, you based everything, all your investments and everything based off of that, right? Um, it's really important not to get sidetracked off your vision. So I would say start there and then create a roadmap around that. I would say, be a master money, not a slave to it. I chased money for a very long time until the market crashed. That was really a wake up call for me. And you just get so blindsided once you start making an abundance of money. It's always weird, right? When you don't have the money, it's all about the money. And when you have the money, it's not about the money. I don't know why that is. It's like you finally get the money and you're like, you know what? This other thing's better than, family, love, friends. I don't know. So I would say focus on that.
I saw an interesting meme today, and I'm sure it's been floating around, but there was a picture of Jay-Z, a rapper, when he was young. It says that he's worth $100,000, and he's got all these chains and rings on. And then there's a picture of him now where he's worth 600 million. He's just wearing a shirt. He's got a wedding ring, and I'd be flaunting that too if I was married to Beyonce. But you can see that before he made the money, he's flaunting it. And once he did, he doesn't need to wear those chains. Or because I think what's happening, I'm talking this with my kids, where you're following what other people are doing and they're buying liabilities, right? Robert Kiyosaki is a liability, is money going away from you. Asset is money coming to you. And chains, cars, houses, all that material things are all liabilities. And I'm trying to tell my kids, don't have FOMO of somebody buying a liability.
Right? Yeah, it's tough. It's tough though.
If one of your friends buys a rental house, right, or a note, like that's when you should have some FOMO, right? We want to have that buying assets, not buying liabilities.
It's hard though when you see that Ferrari. It's just tough, man. You're like, damn, I need that.
Damn, I look good in that.
But now that was when I was younger. Now the mindset is, okay, how many apartment buildings I can buy to generate the income to pay for that, and use it for marketing or whatever to have it as a write-off. But now it's like, to me, when you don't have the money, you think about stuff like that. And when you have the money, you're like, I know I can buy it. I don't need it. I'll just hop in this, 1999 car and be happy,
Now, Fuquan, one thing I'm curious, I like to get some of your input because I know that you recently started practicing infinite banking. And I know you started a policy not that long ago. I was just curious if you could share kind of what some of your mindset was, because this is a little different. And maybe was there anything that got you over the hump?
Oh, yeah, for sure. So I've heard about it for a very long time and never took the action like most things until I really got concrete information. And I'm a part of this mastermind as a gentleman in my mastermind. I specialize in it. And I knew he did it for a while. He kept talking to me about it. He wasn't trying to sell me. We just happened to take breakfast one day and we had a chance to sit and talk for like an hour. And I was like, holy moly, like, why didn't I set this up so long ago? Like, dude, like, he's like, I've been trying to tell you about it. I said, you wasn't putting the pressure. You a terrible sales guy, man. Like, So basically I did the process and I was able to get another policy that I can really do some things within it. I can make investments. I can create arbitrage situations. And I think it's really, really good. I think that it's is something that, especially with financial literacy, a lot of people need to know. So, I mean, with the stuff that you guys are out there doing, I take my hat off to that, because I think even people who are just getting started, like you said, which one of the things I would tell people who's flipping houses and doing stuff now, you should be doing stuff through those vehicles, the kind that you can leverage and build, and still have. A lot of these guys probably don't even have just a loan, not even the whole life policy. They don't even have a regular death policy, like
Yeah.
you know what I mean? They
Yeah.
don't have a will. They don't have anything. They just out here willy nilly. So the basics are important. It's not about just financial literacy. How do you make the money? It's about how do you set up things to protect you, your assets, your family. Like I wished, when I got married, I had a family trust, and everything was in a family trust, and it wasn't in my name, so I would have been protected. So,
Yeah.
but these things you learn afterwards. But yeah, that's my experience with it. I love it. I think that um, it's something everybody should know about, and everybody should at least try to understand it. Right? It's so sad, and we talked about this before. A lot of people had asked. I think the question, why don't people do it, is because they don't see the big picture in it. Right? I think it's important.
Awesome.
Well said. Well, awesome as Fuquan. Again, you've got your podcast, A Passion for Real Estate Investing, and we'll be sure to add those notes those links in the notes, and we'll also include the link to nngcapitalfund.com, so everybody can find you there. Thanks for your time.
Absolutely. Talk to you guys later. I appreciate it.
All right.
Go make it a fantastic day.
All right.